Woo! Here we go. Welcome back. True North, episode 35, the iPhone moment. We are going to get into it. We're going to have some fun today. And we're back after a week off. And, we have lives and it's summer and sometimes we need to focus on other things. And we're excited to be here. So, going to be a fun one today. I've got Ben. He went to go get some booze. And there we go. He's back. And here comes Grain. I think he's going to jump on at some point. But we've got four of us, and we are going to have a good time. We are going to get into quite a few things. And we're going to try to do this in 90 minutes and chop off half an hour of fluff, perhaps, that maybe we've had in past episodes. And I don't know, we'll try this mode and see how it goes. So, agenda for today, we are going to do the classic MSTR leverage and statistics update. We're going to do a Q2 2025 earnings call review and discussion. That will probably be the bulk of this conversation today. We'll go through some of the slides. We'll think about what it means and how we're thinking about it and how we look at things. Lay of the land of the BTC treasuries, there's at least 10 figures of dollars in USD that are sitting in escrow right now, ready to buy Bitcoin. So it's an exciting time to be looking at this space and analyzing what's going on. And then lastly, I've been personally making a really big push on Bitcoin as a unit of account and starting to think of the rest of the world in Bitcoin terms and what that means, and starting to take this stepping stone into a Bitcoin denominated future, or thinking about equities or fixed income denominated in Bitcoin, or how pricing the existing equity market using a Bitcoin framework. Bitcoin risk-free rate, STRF is the risk-free rate, discounted cash flow models using different rates, etc. So we'll jump right into it. It's going to be a good time. And I will start with the typical leverage update. Share my screen here, and we share this every week. Actually, before we get into this, a word from Tim Kotzman.
Ladies and gentlemen, what you're about to hear may be amazing, but it is not financial advice. It's for informational and educational purposes only. Jeff, back to you.
Bingo. Thank you, Tim. And here we go. So, and I'll make this bigger. My screen, we'll focus on it. Okay. So, True North, the investment grade Bitcoin podcast. What is this about? We talk about everything going on in the Bitcoin treasury ecosystem. We talk about using Bitcoin as capital, Bitcoin being the hurdle rate, companies that are adopting a Bitcoin treasury strategy with a really huge focus on MSTR because they are the pioneer and leader in this space, and they're providing capacity and ability for all of these other treasury companies to operate and innovate in the space. So they're really lifting the floor and providing opportunity for others to operate here. And we focus on leverage because this is a big topic. Everybody in the market is, in the past, has said strategy is going to blow up, somebody's going to blow up, because people have blown up by being over leveraged on their crypto in the past. And this story is completely different. And it's different because it's got a very professional financial framework that is conservative and sustainable. And it's really important to highlight this consistently, because one of the common pieces of feedback in the market is strategy is going to blow up. There's going to be a margin call. There's too much leverage. They're way leveraged. But when you actually look at the balance sheet and you look at the numbers, they're actually very conservative, and they're doing everything they can possibly to increase their leverage because they feel under levered. And that's why we show these numbers. So in this column here, BF. So as of 8/6/2025, we are getting deep in this spreadsheet. we're at least 100 columns into the spreadsheet. So Bitcoin held on balance sheet 628,791. Bitcoin price $115,000 as of today. So the assets held on balance sheet, they've got $72 billion of assets, and they've got $8.23 billion of debt and $6.3 billion of preferred stock outstanding. So when you look at the net capital held on balance sheet, you just take the pure math, 72 billion minus 8 plus 6, you get $57 billion of net capital held on balance sheet. So you look at the liability to asset ratio. If you just take a pure liability to asset ratio, you're looking at a 20% leverage ratio and a debt coverage multiple of 5x. And what does that debt coverage multiple mean? That means they have 5 times the amount of assets than they do debt on the balance sheet. So if you were to think about any bear potential scenario here, the price of Bitcoin would need to go down to $23,162 for the assets to be worth less than the debt held on the balance sheet. So you need an 80% decline in the price of Bitcoin, and sustained for a long period of time with Strategy to not have any other ability to raise capital in order for there to potentially be any issues in the future. So very low likelihood, a very strong financial position, and very strong moving forward into the future. And we also show this other column here, the 8/6/25 pro forma. We subtract out the $3 billion of equity that's currently trading in the money. It's effectively equity at this point with where the stock is trading. And if you pull this $3 billion of debt out, you've got a 15.7% leverage ratio, 6.4x debt coverage multiple. So again, incredibly financially strong. Now, I've included this new column, and I think this is how some people should start to look at Strategy and think about these preferred equity instruments and leverage and different types of leverage. And this is something that Ben and I and Matt Cole have talked about in the most recent Hurdle Rate podcast. And we saw with the earnings call this last week, there are different types of leverage. Convertible bond has a maturity. Preferred equity does not have a maturity. And when you think about what is the risk to the company, a debt that has a maturity is higher, more risk than an instrument that does not have a maturity. So when you think about the leverage ratio, if they're taking on more leverage with preferred equity, it may not be necessarily more, or it's just not as risky as convertible debt because there isn't a maturity where those dollars come due. So you can think of the framework, the leverage framework, a little bit differently with the preferred instruments, and they're a little bit more efficient and higher torque on the balance sheet, the asset side of the balance sheet. So what does that mean, and why is that important? So if you look at a 50% drop in the price of Bitcoin, with the price of Bitcoin going down to 57,500 in this scenario, Strategy would still have $36 billion of assets on the balance sheet. And what is this? About $14.5 billion of debt, 8.2 billion of that being convertible debt. And so the net capital that you have on the balance sheet, you still have $21 billion of capital on the net capital free. You could call this free capital on the balance sheet. And the reason I point this out is because it's an incredibly strong financial position. And how I explained this last weekend at the Portland Bitcoin conference, for those of you that weren't there, let's just take this column here and chop a couple zeros off. So let's say you are a personal investor and you have $7 million in assets. If you needed to borrow $50,000, like a $50,000 or $60,000 loan, as an underwriter, if you put your underwriter hat on, would you underwrite that loan? I'd say yes, 100% of the time, because you're good for it, right? You have strong enough capital position that you're going to figure out how to repay me at some point in time, because you could go access different capital markets, you could sell assets, you could do a plethora of different things. Now, take the same exercise and you drop the assets by 50%. Well, now you've got $3.6 million of assets and you still have a $60,000 loan. Would you underwrite that loan? The answer is yes, absolutely, because they're good for it. And you have a plethora of different avenues to go raise capital or sell your assets in case if you did need to at any point in time. So the goal and the purpose of this is, a corporation has significant access to capital in these different instruments where they can tap different capital pools in different markets at different points in time and market cycles. And that's the real innovation here, is that these new preferred instruments all have different volumes every day. They have different volumes. They have different people that are buying and selling them. Algos are now getting involved in selling them. On the common equity, you have different people that are buying and selling it. And then you've also got this access to the convertible debt market, which they would like to not use here in the future, but it's always there. This is always another pool of capital that you can access, or you can access fixed debt markets or do private placements or these other things that people don't even talk about. So they're in an incredibly strong financial position, and that access to capital is what makes this whole thing work. I'm going to pause there. I'm going to kick it over to Ben, Soleil, Grain. Initial thoughts.
I think the spreadsheet's going to get a lot bigger. I think there's a lot more metrics that we're going to have to build into this to keep an eye on it now that we know.
It kind of started.
Okay, good. Yeah, I was going to say that's going to become the focus.
Yeah.
Right. I mean, these preferred stocks, and it was pretty clear, and I know we'll get into earnings here a little bit later, but because it's so clear that they have a path now that they're going down, and they're saying, let's get rid of any maturity or any principal repayment risk in this entire model, right? Let's streamline this thing. Let's make it highly efficient. And let's raise in such a manner that we really have one category that we're going to have to focus on, and that's annual dividend obligations. And I think that's something that a lot of people are missing because they're still looking at, kind of that total debt structure because we still have all the convertible bonds out there. But as those start to roll off and this gets much more streamlined, people are still looking at the notional value of the preferreds. But you have to realize that because these are perpetual preferreds, there's no repayment to that principal coming at any point. So really what they're starting to focus on is just managing that annual dividend obligation. And that's actually a much bigger shift than people think it is. Because the reason why originally you had that 20 to 30% leverage ratio, that strategy was really starting to target is it's because it allowed you to really monitor what type of a drawdown you could absorb for an extended period of time when you have debt on the books that has a maturity point where you are responsible for either rolling or redeeming or whatever the action is that you were going to take at the time. You have a different type of risk in that model. And I think that's part of the reason why all of these new companies that are coming into the market, and particularly the companies that are going to achieve enough scale to be able to participate in this preferred market, I think you're just going to see them completely bypass. Because if you can get large enough, and this is where I think we're going to start, blowing out this spreadsheet and really starting to track it more. And, if people saw me frantically looking around over here, it's because I'm in the nerd data at the moment, calculating out, what does this look like if the convertible bonds are gone? How much coverage do they have of the annual debt obligations then?
Ooh,
if the coupons were gone.
that's in their.
You already have it.
It's in their presentation. 120 years.
Yeah, I was going to say I've got 124 right here.
Yeah.
Today. So then I was modeling, well, okay, what if there's an 80% reduction in the Bitcoin fair market value that they're holding? So, they're down to $14.4 billion worth of Bitcoin. And then what does that give you? That's 25 years of coverage at an 80% drawdown. At a 90% drawdown, they've got 12 years of coverage. And that's only that's if you had to use assets to cover the dividend obligations, right? So that's right. If you had to sell Bitcoin to cover the dividend obligations. So then you look at, well, what kind of liquidity do you have out here? And what does that look like? How many days worth of the trading volume would you need to be able to fund this obligation? And right now, if you've got 12.1 million shares trading hands every day, that's about $4.6 billion that's trading around the common stock equity every single day. So right now it takes about 12.5% of 1 day's trading volume to fund the annual dividend obligation. So it takes very little for them to use that ATM on the common stock to actually pay that dividend. And then when you get down to 80%, it would take you a little bit over a day, assuming it was trading at 1 times NAV. So it'd be trading at about $46 a share if there was an 80% drawdown in Bitcoin. And then you normalize that out, they're at about $46 a share. So that would be 105% of the daily trading volume that would be required to fund the dividend obligation. And if it goes down 90, then it would take 2 days, assuming the volume held. Obviously, it would drop down. So anyways, it's going to be interesting to start monitoring this because it's a completely different risk profile. And you're really starting to focus more in these models, one, on the resiliency aspect, right? And I think that's that coverage, that how many years of coverage do you have on the dividends, like you're showing on this slide here. But then the other metric to start watching is you continue to monitor that trading volume, right? How much activity is there around this equity? How much liquidity is out there that they're able to tap to pay these annual dividend obligations? And then you can model, what is the risk, right? When does it become a heavy burden on drawing out of the common shares via an ATM to fund these dividends? And it could be a very, very long time. A lot of ways to pay these.
Yeah.
So I think this is just being completely missed at the moment how much more resilient this model makes them than when they were using convertible bond debt. I know there's a lot of people championing convertible bonds at the moment out there, and I think they're good. And I think there's going to be a lot of companies that are going to, move into that niche, because I think a lot of the companies that don't get large enough to issue these preferreds very quickly, I think that they're going to have to find a market where they can start to scale, and they're just going to need to be accepting of the fact that there are different types of risk that come into the model when you have to use something that has a maturity aspect to it. But, I think that for the ones that scale enough, it's an absolute no-brainer for them to bypass it if they can and go straight into the preferred market and really focus on managing that annual dividend obligation and building a model that's incredibly resilient to massive drawdowns. I love that Saylor answered that question so clearly. I think it was Lynn that asked that question, and he started giving the examples of, at 80%, nothing happens, at 90%, I guess it starts getting fun, right? And they're going to have to start dancing a little, but it's just a total shift. So,
Like
I know
we
we'll
run the
go
model.
into this as we go through the earnings, but I just, as I was looking at the numbers, it was even surprising me just how much coverage they would have in the event of a massive, massive drawdown. So I'll clean it up and make it pretty and put it out in a poster at some point, but I just thought it was an interesting observation.
And the cool part is when you start to conceptualize that the scale of capital that would come in the door to even get to that point where it would be an issue, it would be an astronomical number that's going to buy Bitcoin that hasn't existed before. It's going to put us into new territory. And thinking about that concept is pretty cool. But I think you're right, Ben. The convertible debts could be really valuable in to the extent that strategy is going to retire these. That market is going to look for a place to park that capital, and they're going to, since they've succeeded, they're going to
be hungry.
They're going to be hungry. And those small companies that they could have a really big opportunity to get to that next level, and it might be they might have to work through it, right? And maybe go through a bear cycle like Strategy did, where people are yelling about their stock, and just wait it out and get to a new echelon where they can start running these instruments and moving a bit quicker. So it's going to be useful for a lot of those smaller companies, I think.
Yeah, I mean, Strategy being, for the last year, the largest issuer in the convertible bond market, that does leave a pretty major vacuum out there. And I think that a lot of these convertible arb desks, because they realize just how powerful holding corporate bond paper that's tied to Bitcoin is for them to implement their own trading strategies, there's going to be a lot of demand. And because of that, I think now there's an opportunity for that to get spread out amongst more of these companies. So I'm not expecting the convertible bond market to, just disappear from the strategy. And quite frankly, we should acknowledge that it's really what got Strategy to the dance in the first place.
Right.
So you can't even look back at Strategy and go, well, that was a bad idea. Well, that was the idea that got them to the dance. It built the scale that they needed to evolve into this next form. Now, going backwards, knowing what they know, yes, they may have deployed the strategy differently, but it doesn't mean that it served no utility or that it put too much risk into the model, right? They were very conscientious about how they did it, and it gave the market a massive education in how to manage that risk that comes with these, including things like building out that debt ladder and staggering your maturities and giving yourself a full Bitcoin cycle to allow for these to perform. But we'll see what happens, because obviously in that market, it's tied to what the volatility is doing. And, volatility has been pretty low recently. So that's going to, drain some of that excitement out of that market. And you might not have the same level of capital available, but this goes in cycles, right? Volatility comes, volatility goes. So I think it's far from over in the convert market. And, I'll be watching for which companies do pop up that start filling that void, because I think there's going to be several that try to achieve their scale, and that's going to be the tool and the capital to do this. I don't think, but that get
Breaking up.
It's been, it just makes sense to move to the prefs if you can, right? You're targeting a much bigger market, and you get to be creative. You don't get to be so creative in the convertible bond market. The creativity was the fact that these were all Bitcoin driven instruments, right? By the volatility on the balance sheet of these Bitcoin treasury companies. And so that made for wildly volatile equities that people were embracing instead of viewing as a risk. So that created that opportunity. But now in the prefs, now that you know that you can basically just, hammer the silicon and create your own products and tailor make these for specific use cases, I think there's gonna be a lot of excitement in the preferred markets.
Yeah, it's not that the bonds are bad. They're like training wheels. If you can't go straight to the preferreds, it's okay to walk before you run.
Well, and I think in the early days, you'll see people go to them as well because they're not immediately dilutive and you can raise at a premium, right? So for some companies, if you've got the option of going straight pipe type of a transaction where it's completely equity and maybe you're a smaller issuer and you're looking to minimize the amount of shares you're putting out early and you want to be able to raise some of that capital at a premium, you might get out of the gate with a convertible bond. So I think they'll serve utilities given the various phases that these companies are at. And sometimes that's going to be the market that's open, right? These markets aren't open all the time. It's part of the reason why getting to a model like Strategy has, I know people get sick of us for, praising Strategy's model and all this, but they're the ones innovating here. And, that's something that I'm not going to shy away from acknowledging. The reason this entire industry exists is really because Strategy really pushed the envelope here and gave everyone else the confidence to be able to pursue this. And they're the ones that are ahead of the curve in all the products that they're issuing, and now the structure for how they're deploying them. And one of the things I look at now is as this market evolves, how do you get to a place where you can execute efficiently and within your own control? And those two things are very important to me as I look at this model. Because recognizing that these different markets aren't always available to you. It's not like you can just go to the convertible bond market and get a deal done whenever you want to. It's not like you can just go and do a private placement pipe deal whenever you want to. And there's always capital there that's available. That's not how it works, right? A lot of it is tied. Yeah, it oscillates. And a lot of it depends on what the latest deal in the market was and how that deal performed for the investors, as to whether they've got the appetite to re-up and redeploy that capital back into the market. Convertible bonds, obviously, it's all about the volatility, and you want to get a good premium and you want to get a good coupon rate so that you're not straining your business. So those markets aren't always available to you. So when I look at these models now, part of what I put a huge amount of value on when I'm looking at these companies is how efficient is the execution going to be? And by that, I mean, if you look at Strategy's model and where they're moving, so say they shed the convertible bonds, now look at how they're raising capital, right? You've got the common stock ATM that's out there and always available for you, but the ATM on the common stock is a delevering tool. So they're moving away from that for now, but that lever's always available and they can pull it whenever they want to, right? Now you go into the preferreds. Well, it's the same structure. Right? You go through the IPO process, and that, don't understate how much work it is to go through an IPO. That's a pretty difficult process. And the fact that they've been throwing these out, as rapid fire as they have is a pretty impressive feat in its own right. But once you get through that initial IPO, and once they get the products out there that build this yield curve for them, now you're back into the ATM model for the preferreds. So even for the products where you're raising the most accretively, you're using an ATM, which gives you ultimate flexibility for your execution. So you build the foundation of this, you go out and you get the approvals for all the capacity on all these products through your filings. And now you're in total control over when and how rapidly you raise capital. You're not going through the constant sales cycle and doing the road shows and doing all of this stuff. It becomes very efficient the way you raise capital. So right now, what I see them doing is building out the framework and getting all the pieces of the puzzle in place so that at that point, the team can now focus on optimizing for which ones of these products they're raising at based on any given market condition. And they're going to start scaling them so that they can acquire really rapidly. And because of the characteristics of these products and because of how much coverage they have, right, that 124 years on the preferred so far before they scale them even more, and they buy more Bitcoin, they're just going to be in such a sound place where if you look across the industry and you go, who's the lowest risk play? if I want to buy one of these fixed income products, you're competing on the credit quality. And right now that's coming through strategy. So I've kind of shifted in the way, well, it's not really a shift. It's evolved right in front of me, right? I didn't see all of this coming. But now that it's out here and you start looking at, what's on the board, I really value that efficiency of execution, right? For the company
Yeah.
to have control over their own future and their own execution as the opportunities present themselves. I don't think you can understate how valuable that is.
They built a robot for capital raising. It's like Hershey's chocolate before, like if you were to make Hershey's chocolate bars, you got to do a lot of work as a human, and you make a chocolate bar and then you got to wrap it and then you sell it. And then you go back to the beginning.
You got to build the machine before you
do a
can
lot of
turn it
work.
on, right? So
You make a chocolate bar, you wrap it, you send it out. You go back to the beginning. But now you put a robot in place, and you're like, okay, let's just take all of that work out of it. Let's just put a robot in place, and we just put the ingredients in, and we get the chocolate bar. It's already wrapped out, and then we send it out the door. And like that's what they did with the prefs and the ATM on the prefs. Is it just automated the whole system, so they're able to bring that capital in the door when there is appetite and energy flow coming in the door on those different instruments, which is, I mean, monumental, but totally monumental. And the innovation here, right? This is like they went through the challenges of the convertible bonds and saw, okay, this isn't the best, and let's go try these things where it's a little bit more efficient. But the other thing that you mentioned, Ben, which I think is really good to point out, is the convertible bond terms are the interest rate and the premium are terms that can be levered in different directions depending on the type of company you have. So if you're a company with like really high cash flow, maybe you crank up the dividend to, instead of 0%, maybe crank it up to 10% and you drop the premium, the conversion premium, by 50%. And maybe that's how you get out the door. It's like, okay, let's go raise $100 million or $250 million, but we make it a little bit more favorable because our business model's got great cash flow. And there's going to be so many more players coming to the space here, and there's going to be opportunity for people to raise capital with those vehicles. So
yeah, you're going to need another line in the spreadsheet, because it's almost like the convertible bond leverage ratio is completely different than the post-convertible bond era leverage ratio, because the bond era had higher risk even with the same number.
You need a weighted average, a risk-adjusted, torque-adjusted leverage ratio as a function of your actual annual liabilities, or like your maturity liability risk. So,
yeah, but I was glad to see it. I was looking like Grumpy Cat with the low leverage, over the last few months. But the joke was on me, because that slide that they showed with the yield curve that they're building out, and there's that big blank space in the middle, and there's room for at least two. I mean, if I want to squeeze them in there, yeah, exactly, right there, the future opportunity. I mean, I'm figuring there's room for 2 to 6 more preferreds. I mean, I don't know how many AIs got lined up for them, but it just, I was thinking, okay, they're going to knock out all these convertible bond deals, but they didn't need to. They really needed to keep that leverage ratio low to make room for the preferreds that they knew they were coming out with, but we didn't. You know what I mean? Like, I didn't know. So I'm just clamoring for the convertible bond deals. But of course, they've been planning these things for months. So, they made room, and they needed to make room. So it just kind of all worked out according to plan, I'm sure.
Hey,
I had
Jeff,
a new. Yeah, go ahead, Grain.
Yeah. So you know what?
Yeah.
Could you go to slide number 19?
Yeah, we're gonna come back. We're gonna come back to this. But
yeah,
absolutely.
But I wanted to make this comment relative to what you were talking about in the very beginning. I think we should have two metrics: MSTR and the Bitcoins that are held on balance sheet, and obviously the debt, and also the rest of the preferreds added together, which is in the right column, the enterprise value. And I think that as those begin to grow, the enterprise value, that's what we should look at as the market cap of Strategy. There's a market cap of each one of these instruments: MSTR, Strike, Stripe, Stride, and so forth. And so when you add, and Ben, please correct me, there is no partitioning or securing any of these Bitcoins to any of these instruments. They're just in one one pot, so to speak. And
That's
then
correct.
all of these assets have, now there's a difference in the capital stack, and you guys, the preferences, sorry, the,
Yeah.
relative to that, I'm not changing that, but I'm saying I think that the enterprise value is how we should look at the market cap of Strategy. And when somebody says MSTR market cap, they're talking about just the market cap of MSTR, not Strike, Strife, and Stride
Mm.
and Stretch.
Right. And all of these can be that size.
And when you
can be 112 billion.
right, so if the person that we think, Fred Krueger, I don't know if he's listening, but he actually thinks that Stretch is a good idea, STRC, and if that can go to $100 billion by itself without diluting the MSTR shares, I think that's incredible. That's what I posted about a couple of days ago, and a lot of other people have posted some great content on this in the past few days. That's why I'm so excited about MSTR, because of the guidance that was in Q that they put out.
There was guidance.
There was guidance.
This is the first time they've ever put guidance.
First time we ever had that. So I don't want to derail anything, and we can jump to the quarterly report. But I think that in your chart in the beginning, I think you should make a new column and put in, Stride, Strike, Stretch, and Stref.
Enterprise value.
Right. Or
Yeah.
FCKD.
Yeah, absolutely. And going back to this, so like the opportunity, like the future opportunity here, medium duration. I think there's also an opportunity on the really, really short end duration, right? STRC has a 1 month duration. What about a daily duration, a money market fund, in like an overnight, single day money market fund where there's a daily yield?
I think that's an awesome idea.
There are so many banks that, well, I guess there are probably potential issues there, but
well, think about think about this. They've got the perpetuals, which is the long end. I mean, you don't get anything longer than perpetual. So the idea behind this is they had an overnight that would be even better, and that's probably the shortest duration you could possibly do.
Yeah. There's more here. And I don't know how much more here, but I think there's a lot more here.
Yeah, and I'm not going to give financial advice, but if somebody wanted to go into the space and they don't buy individual stocks, that's a red flag right there. Like if you can't buy Apple stock or Microsoft stock, buying MSTR is pretty crazy. But if you were to say, look, for the proverbial $10,000, you divide it up into 5 buckets of $2,000 each, and you buy 5 racehorses. It's the same 10 grand, and you put it in MSTR and all the preferreds. That's your 5 assets, and then you watch 5 racehorses, and they all work. It's all based off of Bitcoin.
Yeah,
right.
They synergize.
Right. You tell people buy. You don't tell anybody to buy anything, but you buy them all on the same day, the same dollar amount in fiat terms, and then you watch what happens over 6 months. The problem is when the cycle is high, they're like, oh my God, I should have bought more MSTR. And then when it dips down because of the volatility, not risk, because of the volatility, they're like, well, I'm happy that I have the
low vol. Yeah, the low
right,
vol.
I have those. And
Yeah.
so that's where people will watch the same company. I think this is the only time where we could see this. The only company that has the same asset, like we said, that's not partitioned, but yet there's 5 different flavors of returns. And some returns are paid as dividends and stable price, and others there's no dividends and only paid as appreciation.
Absolutely. Shall we jump in a little bit further into this thing? Because I think this was another monumental earnings call for many reasons. 1, they provided guidance. 2, they went through all of the different preferred instruments and gave us an outline of exactly how these preferred instruments work. They outlined the general liquidity, the collateralization of these instruments relative to everything in the market. It was just an incredibly data-heavy presentation that just showed all of this information in really condensed ways. So I'm going to go through a few slides that were really impactful to me. Maybe we just kind of unpack them and talk about them. If you guys want to walk through anything, or if there's anything coming to mind, let's talk about it. And I'm going to start. Yeah.
I'm going to chime in
Go
here
ahead.
real quickly. And we're not going to talk about this now. You can go through this. The most impactful thing on the Q2 report, Jeff, was your question. You had the last question, and I dialed in at 45 minutes in, and I said to friends, how'd it go? I got in 45 minutes late, and I still listened to it for an hour and a half. But your question at the very end, that was the question I want asked. And Lynn had a great question in the beginning, but you had the best question, and we'll get to that. But I wanted this to be in the beginning of the recording, to have people,
Yeah.
so they listen to the recording, they can listen
Yeah.
to that. But your question was the best question. But go ahead.
Yeah, it's the characteristics, the characteristics of the leverage, which is kind of what we hit on here in the beginning. The characteristics of the leverage have changed now that they're rolling off the convertible debt, and you could take on more leverage hypothetically with the preferreds because there is no maturity, and you just have to finance the dividend obligation. How are you going to pay the dividend obligation? Well, look at this, what you're seeing on the screen. Look at the liquidity of all of these instruments. Look at how liquid these things are. Look at how they've traded. Look at their relative risk profile relative to everything else in the market. There's no doubt that the rest of the market is going to catch up to these, or they're going to identify these as opportunity because they outperform everything. It's not like they're a little bit better than the existing things in the market. They absolutely crush everything.
Yep.
Absolutely crush everything on every characteristic. So when people used to look at Bitcoin, they would see Bitcoin as career risk. Like, oh, if I got Bitcoin exposure on my balance sheet, and I'm taking career risk. If this blows up, I'm screwed. I'm out of a job and I get fired. I can never get a job again. Now, the plumbing and the architecture has changed. There's going to be a scenario within the next 4 years. If you're not looking at these instruments and you're a money manager, you have career risk. If you are actively seeking to not take exposure to these things, that is a position. You are short these instruments. If you're holding all of these other instruments and you're not holding these, you are short those instruments. And that's going to be a form of career risk, in my opinion, in this fixed income money market, money manager space. If you don't have Bitcoin backed credit on your in your portfolio, you're going to get killed by anybody else that does. And that capital is going to flee. They're going to say, hey, why is my fixed income portfolio underperforming Joe Schmoes over there by 200 basis points? Like how are you getting crushed by 200 basis points? Like, what are they doing? And it's like, well, they leaned into Bitcoin backed credit and they're outperforming the market. It's like, well, okay, I'm going to go over there. And you've got this entire generation baby boomers that is leaning into their fixed income portfolios and relying on their fixed income portfolios and their real estate portfolios. And they need these things. They need these products, and they're too good to not hold. So how long is it going to take before we see massive inflows in these things? I have no idea. I have no idea how long it's going to take.
I've got a comment about this very particularly. So some in my family, there's some older family members. Obviously, they know exactly what I've done, but they still believe in CDs, certificates of deposits. What I tell people to do with certificate of deposits that when I talk about this is, again, the proverbial $10,000. If you're going to do a 6-month CD, don't put the 10 grand in at one time and then have to wait 6 months in order to get it. Take a quarter of it, $2,500, put it in, wait 6 months, build out the same ladder, the same dollar amount, whatever you get. And that way it rolls over. So if you need the cash that comes out, you don't have to wait the full 6 months. Obviously, after the first time you do it, you have to do it. So you then stagger the maturities of your CDs. Now, the people on this
You're
call,
sounding ancient, Grain. I mean, CDs.
No.
CD ladders, my God.
No. Listen to how this is related. So now if you buy STRC, there is no ladder.
There's no ladder.
You just buy it and then you get out. And
it's liquid.
You can't sell a portion of a CD. With this, you could sell to the boomers and the old people. You say, hey, you can't sell a portion of a CD and lose that interest, which is minuscule on this. If you buy this, right, not with all your money, and if you buy this, you could sell a portion of it at any time. And that way you have a conversation that somebody can understand that's older.
Right.
Yeah.
That's the benefit over a CD.
It's
right
liquid. It's liquid. That's
Instantly
why I'm on
liquid.
this page. Like, this liquidity is and we talked about this on the hurdle rate. Liquidity is a risk charge. Like, lack of liquidity gets a risk charge. If you're holding, $100 million of Boeing preferred stock and you need to get out of it, well, it's like, how liquid is Boeing preferred stock? How many people in the market want $100 million of Boeing preferred stock? It's pretty limited. So you have to take into consideration like the liquidity of these instruments and how quickly you can get in and out if you can't hold through the duration of them. And now you have liquid instruments that outperform the yield that you can buy and sell at any point in time, and they're absolutely crushing everything in the market. That deserves a premium. The yield on these should be far lower because of how liquid they are. And this is huge. This is so big. And people, 99% of people don't get it. And they don't understand how like monumentally enormous this is. And they're going to continue to be more liquid because there's going to be a lot of people buying these and selling these, moving in and out, moving between MSTR and Stride and Strife and Strike. And there's going to be algos trading all of them. There's going to be these huge pools of liquidity in all of these instruments, and they're just going to continue to grow, especially as institutions wrap their heads around this.
Yeah, let me try. So all of us were there. There's a picture of us at the Bitwise event in New York City. And it was after the event was over. And Saylor, we go up and we talk to Saylor. In fact, I'm actually in the picture showing my face. I'm reading all the comments that come up here. And so I was there, but I was credited, but everybody's like, which one's Grain? But anyway, the important part about this, and Jeff, you remember this because I was standing next to you. And Saylor just goes on this epic rant for 45 minutes talking about the treasuries and exactly what you just said. I am not a bond trader. That is not my area of expertise. And he's like looking at us like, Jeff, and what do you think about this? And you remember this, Jeff? Yeah. And he's going on. And what about and he goes on about,
like, I'm selling these to insurance companies.
Right. And he's saying this to us with this passion. Now, he did not disclose anything to us about STRC or what was happening, but obviously he knew about this because it takes months to get this done. Like Ben says, to do an IPO, and ends up being the biggest IPO of the year. And he's talking to this and he's so animated, excited about this. And people, if you could ever go see Saylor in person, and you go up and you just talk, introduce yourself and say hi and ask him I asked him a question that was a dud, but it may become important. The question was, will you trade these in other currencies? And he's like, no, because I can raise tons of money in US dollars. And then it clicked in my head recently. What happens if Strike is available? STRC is available in another currency like yen or euros or pounds. So,
this thing's revamping the entire financial world.
This is a big deal. Why am I so animated about this? It's because of the guidance, and it's because of STRC, something that I'll probably, maybe I'll use it short term. If I get out of a trade, what am I going to put it into? I'll put an STRC, right? So it's not going to get me rich.
Grain, if you push the clutch in, you now have an instrument backed by Bitcoin where you can you could push the clutch in and still be in Bitcoin, which is like, come on. Come on. That's awesome.
I tell you, Grain, it's good to have you back. I know you left Team MicroStrategy here for a little bit, but it's good to have you back. I like this energized Grain.
Well, maybe being a little bit salty had some effect.
Hey, people just you got to give it time, man. If you are
give it time. Look at this.
Come on, Grain. You're out racing motorcycles and supercars. You can't pull the old card.
If this grows any longer, I'm going to look like Santa Claus.
Love it.
Grain's got testosterone just coursing through his veins. He's not an old man.
Yeah. He's just filled with adrenaline. You see any picture of Grain, it's some, flying by the edge here. He's just ripping around corners on racetracks or something. This is an adrenaline guy, so I get why he does high octane investing too. But I think one of the other things to focus on here, when you look at these charts, and you can also look at the next one as well, but look at the grouping on the left. I think just because this is around these specific preferreds, everyone ignores the massive cluster on the left of the chart.
Yeah.
Those are
I think STRC is also
no, I'm not even talking preferreds, Jeff.
Yeah.
Further
yeah. These
those are all other products that somebody is buying.
Yeah.
right? So when you look at this and you go, all right, well, Strategy has 4 of these products in market. Is this market saturated now? This is a what, $1.3 trillion market globally, the preferred market so far at the
Yeah.
moment. And there are buyers holding all of those other products that are massively underperforming all of these Bitcoin-backed credit instruments by yield, by liquidity, and on the next chart, it's by collateral position.
Yeah. This is a
I
good one
mean,
too.
these are such superior products relative to what all this other capital is holding. The difference, I think, is that these are new. It's a new concept, and the market is always going to have to digest new concepts, and that's where opportunity comes in. I think one of the most fun things watching all these preferred, people are gonna get upset because it's not just MSTR and it's not the high octane version of it. I think people are gonna stumble into capital appreciation accidentally with these products,
Hmm.
right? You're gonna buy them for the yield while it's down here at the 10%, and then all of a sudden that risk is gonna reprice. And that yield premium's gonna compress, and all of a sudden it compresses by the price of the shares going higher, right? That's what brings down those credit spreads. So, like, I think there's gonna be a lot of people that are accidentally going to stumble into capital appreciation on their fixed income products, and I think that's gonna be pretty funny to watch when the market finally reprices the risk on these.
Yeah,
Yeah.
every single one of these is a category killer, and they're gonna keep coming out with new ones until they have one category killer per category, and they're just gonna have the best preferred in every single category.
Category killer. Yeah. Exactly. Every single category. And to the extent they do get repriced down, there's probably both of these got to move closer to each other. I would assume both of these move closer to each other, and then the strategy instruments get cheaper because they're liquid
Mm.
and less risky and digital compared to physical risk. So there's going to be like a flippening of, wow, that's crazy. There's going to be a flippening of traditional fixed income and digital fixed income. Like they look so crazy right now, but yeah, they're going to go the opposite way. And that's going to bring Strategy's cost of capital down like in half, which is like rocket boosters on bringing Bitcoin in the door and on the balance sheet. That's just like, oh my God, this is it. This is the
That's what
biggest
they
idea in
look
all
past,
finance.
right? That's what they look past, is that, as those yields come down, their ability to raise just accelerates, or at least, the premium relative to the obligation that they're putting on the books here for these annual dividends, it lowers. So it's just such a massive shift out here that the market's completely asleep on right now. But it is a different way of thinking, right? I mean, when you look at all of these other products, you got to look at, what are you betting on, right? What is backing your belief in this product? Are you looking at the requirement for the future performance of this company to generate cash flows to fund these new obligations? Or with Bitcoin-backed credit instruments, now you're focusing on, well, how over collateralized am I with the asset? But then you're also looking at, what is the liquidity of the engine that's fueling the payments for all of these products? So it's the combination of the two that makes this so powerful. So you can look at it from just a collateral perspective and go, wow, this is safe, right? I'm so over collateralized. I can watch this in real time. I can adjust my positions as I need to. But then you look at, well, now I need to look at the next layer and go, all right, if they're not selling the asset that's effectively collateralizing these products, now I want to look at the next layer, and I want to look at, where are they generating the income that's paying for all these dividends? And then you go down to that level and you realize how deep the liquidity is on the common stock and how little of it actually takes to fund these obligations. So everyone who, gets upset saying, well, they're using the ATM to fund these. Well, the ATM of the common stock became their primary product that they created and released to the market. And that was a lot of the early day discussions that we had on here, was about how they were effectively introducing their equity as their newest product, right? It's not a new software platform. It was the stock. The stock was the product, and they were engineering that product to be superior. And now they're doing that with different categories, but they're using that core product offering to make everything else run. So it's
Yeah.
such a unique way to reframe these types of products and figure out which ones actually offer all the superior characteristics to attract capital. And when you look at it through this lens, it becomes an absolute no-brainer if you're in this market. Why would you be holding any of these dots off to the left if they're less collateralized, they're offering me a lower yield? Like, why would I be holding on to those other than, that's how these products used to be structured. I don't understand. Bitcoin is probably going to be the main answer, but these things are going to be powerful, and it's not going to take that long.
Can we talk about valuation?
We can talk about valuation.
Talk about valuation, because I think this is where I get really fired up, and because I think I've gotten a lot of flack because I feel like I see the world in a different way than a lot of people, which I think is fine. I've had a lot of adversity in my life, and I'm not going to change the way I see things. So I'm just going to go for it here. As these instruments become more successful, you're going to get more Bitcoin held on the balance sheet, and the value of the assets held on the balance sheet is going to rise. The assets that are relative to MSTR are going to continue to rise. Now, what is the value of the equity? The value of the equity is its ability to store value or distribute value to any of its holders. And this is like it's almost like a value investing thesis. The value of the balance sheet is insulated to any AI innovation disruptions, and it's going to withstand the future, right? If everybody thinks that Bitcoin is the strongest asset on the planet, which I personally do, I think this is digital gold. All the characteristics are much better. I think it's going to go to the top of the leaderboard. It's going to surpass gold and keep on going. So if that's the case, if I wanted to store value, I can store value in Bitcoin. I could store value in the company that holds the most Bitcoin, or any of these other companies that are accumulating Bitcoin. And this is really a value play here, because you know that the architecture of the equity market is a function of the market cap of these instruments. As larger equities get larger, they have passive index flows that are coming in the door to buy the stock at any price. This is just the way it works. So, like, one of the reasons the Mag 7 is stayed up as at the Mag 7, not only do they have great products, and like really great access to capital, but they also have continuous passive flows that are coming in the door to buy the stock and to continue to push them up there, which continues to give them easy access to capital, which continues to allow them to do their operations that they normally do. Now, it's a little bit different here because you have a really strong asset side of the balance sheet, but you know that asset side of the balance sheet is going to get significantly larger because of the way these instruments are designed. So it's only a matter of time before people start to reflect, what is the value of this instrument? What is the value of the future compound annual growth of this instrument? What is the value of the future accumulation of this instrument? And what is the future value of the future accumulation of this instrument? And it just kind of compounds on itself. So, and the architecture of the market continues to push it up there and keep it up there. So I think it's undeniable that it's going to continue the market cap of the underlying equity is going to go higher because of the structure and the architectural design of the equity market. And where you get in on that point of time is your perspective on how you view that equity in the future. Same thing happened with Berkshire Hathaway. And we talked about this, I think, a little bit on the Hurdle Rate podcast. Like Ford Motor Company used to be a balance sheet company. Strategy is a balance sheet company. Insurance companies are balance sheet companies. Banks are balance sheet companies. Berkshire Hathaway, balance sheet company. And Ford, when they were first creating cars, they were obsessed with building their balance sheet because they wanted to insulate themselves for any downturns that happen in the market. And if there's downturns in the market, having a strong balance sheet is really helpful because you can continue to do business into the future. If you think about any of these companies in the S&P 500 right now, 493 out of them are underperforming the S&P 500. 7 are outperforming the S&P 500. And those 493, if you don't have a strong balance sheet and the market turns on you, the value of your company disappears. And having a strong balance sheet gives you continued access to capital and continue to grow. So it's I think, largely overlooked by people that are throwing these crazy valuations on equities that have a lot of uncertainty in how they're valued in the future, and they're really dependent on some future expectation. But if your assumptions on future expectations change by like even a quarter basis point today, your valuation assumptions change drastically. So
You know, I wanted to chime in here on this. I think that what Saylor said in the Q2 earnings report was that he's paying 500 bips above SOFR. And what I liked about that was that it was a fiat metric. So his metric is not 10% of the Bitcoin CAGR. His metric is if interest rates continue to go down, he said 500 bips above it, but as SOFR goes down, the overall rate goes down on STRC. Ben, please correct me if I got this wrong.
Nope, you're
So, right. So from that perspective, his hurdle rate that he picked, I don't want to sandbag sounds terrible, but he picked a lower rate, and I think that's why if a preferred instrument can't pay 500, 500 bips or 5% above SOFR, then why would anybody buy it? You could just buy treasuries, and that would be, you get, the full faith and backing of the US government, provided you believe in that. So I think it's an easy number to say. I think that's an easy number for people to understand. And the fact that it's over collateralized, most times when you look at a company bond, it's based upon the cash flow of the company or some assets that they pledge as collateral. It's that company's. With this, it's Bitcoin. It's not Strategy's cash flows from their operating company. It's not Strategy's buildings. It's a non-correlated commodity. I think
that they're accumulating
at
an incredible pace.
Right. And
with a fixed supply.
And it has a network for delivering it, roll all the Bitcoin, awesomeness into it. But they have a great chart on it. I'll tell you which it is in a second, but keep on going.
Yeah, it's this concept. There's this concept in finance, and this is probably too jargony, but there's this concept of weighted average cost of capital, and one of the components of the equation is the risk-free rate. And if you just change your risk-free rate assumptions, well, what do we know about the risk-free rate? Risk-free rate is the rate at which the government pays you to hold their instruments because you know that the government's not going to fail. So, all right, so the risk-free rate is, I don't know, 4.25. Well, inflation's what we found is like near 6.5 to 8. Okay, so what if you just change that risk-free rate to what like the inflationary rate is? Any assumption, if you just change your discount factor, any assumption on the valuation of any one of these companies drops, the valuation today drops drastically. And if you change that to, this inflation factor or STRC or STRF as your risk-free rate, the way you value these companies probably drops in half, and because it puts a lot less value in the future cash flow because your opportunity cost of capital today is so high. And that's kind of what I've been trying to point out with some of the graphs and charts that I put together. We're like looking at net income over time priced in Bitcoin. Maybe we'll get there. Maybe we'll get there a little bit. This is probably a little premature. And we'll talk about that. But
so can you pull up slide number 10? Yeah, you see, I like this slide. And one of the reasons why I like the slide is that comparing, if you look at 2020 to 2023, you see that their ability to has consistently delivered Bitcoin yield since 2020. But if you look, diminishing returns didn't set in. What happens is from 23 to 24, it went up 74.3%. This is their numbers, not mine. And then you look at it went up 25% for the first half of this year. So let's just assume ceteris paribus, it all stays the same, and it ends up going, their Bitcoin yield goes up 50% in 1 year. I'm like, well, that's a really great metric. Now, this is independent of the stock price, but it shows their ability to raise funds. So with that said, I like slide number 10. I mean, I think we should go through the deck and everybody picks out their favorite slides and we could talk about them, but this is one of my favorites.
Well, this is the first time that they actually published this metric, right? Not the yield, but the actual sats per share.
Sats per
So
share.
I
That
think a
was
lot
big.
of people overlooked that, right? This used
I
to be
did
one
not
of the
know that.
charts I put out all the time because they would never report on it. This was the very first time that they actually formally put it out. So it was cool to finally see it show up in one of these decks.
You know what, Ben? It feels like I just put on a nice warm sweater when you said that.
You can take that off your plate now, Ben.
Yeah, I guess I could offload that one. Yeah, that one's in Sailor's hands now. I think they'll do all right. I will say, just as a general overall, one thing I did really like about this last earnings call was the way that they also put Fong out there a lot, where he was covering a lot more of the discussion as well and kind of giving Sailor a break on some of this. It was great to see that full team starting to get more and more engaged. And I think that's critical because anytime you have a figurehead, that's as inspiring as a guy like Sailor, they tend to be the ones that have to carry the load here. But it means that people don't realize how powerful the team is that's backing this thing. I mean, it's incredible. Anybody you talk to on that team is as sharp as they come. And so starting to see them become more public facing and start doing more of the discussions on these earning calls, I think that's huge because one of the early days discussions was always around key man risk in this strategy. And I think we've probably moved past that now. I think that a lot of us, obviously, Sailor's still the figurehead over here because, he's the visionary that's made all this possible. But when you know that now at this scale and the maturity at which they're operating, that you have a team that can carry this load for you, that's massive in terms of, building that confidence in the market. So I just wanted to say it was really awesome to see that come out in this earnings call.
Yeah, he had one of my favorite quotes and I can't remember which slide it was, but it was the one where they were listing strategy in the list of sizes, and he said that they don't want to just be the biggest Bitcoin treasury company, they want to be the biggest treasury company.
Yes.
And I was like, okay, Fong is just dropping the hammer.
Boom.
I immediately screenshotted on my phone. I was like, screenshot, going back to listen again.
The biggest treasury company. And look, I mean, they're not far. Right?
Yeah, and Berkshire Hathaway was at the top. So it was like, okay, Berkshire, you going to buy Bitcoin or you're just going to wait for strategy to acquire you?
Right.
Another metric that I thought that was awesome from listening to the call, that at the end, first of all, the amount of people on the call rose the whole time. And anybody that does a call knows that usually after the first half an hour, people drop off. But when I joined, there was a little bit under maybe 30,000 people on the call, maybe 40,000. And at the end of the call, 2 hours and 15 minutes, 80,000 people were listening to an earnings call. I mean, that's just got to be a
That's
record.
insane.
I mean, Ben, you have any idea of what happens on a Tesla earnings call or a NVIDIA? How many people?
I mean, I have no idea, but these earnings calls, in my opinion, are one of a kind, right? Most earnings call you go to, it seems like people are reading a hostage statement, right? Like they're captive and they have to read exactly what the lawyers told them they could read.
Right.
So the ability to do it this way, where you're using it not just to run through the numbers, which obviously they do, and they give you all the normal disclaimers, but then you use that time while you've got everyone's attention, right? Everyone's showing up for an event, the earnings event, and they want to see what the performance was. But now that you've got their attention, you've got the ability to educate them. And I've seen it over and over now as they've started doing this more often, that it completely resets market sentiment when they do it, because people reorient themselves to the long-term vision and they stop looking for optimizations for a day or a week or a month. And they realize that you're building the framework for something incredible that's going to be able to last for decades. And we're all guilty of it too, right? I mean, you get impatient, you're waiting for things to move, you don't know what they're doing. If you don't hear from them all the time, you assume nothing's happening, right? I mean, that's human nature. That's just how people get. But when they do these, and this is really when they take the time to engage investors in a way that I haven't seen any other company do, you're taking the opportunity to show what the world looks like through your lens as a corporation, right? Here's how we're going to leverage the strength we've built. And here's the markets that we're going to go and dominate. And here's exactly how we're going to do it. And running through that in the detail that they do and level setting it with data like you're looking on here. This is really data heavy for any of these types of presentations. Typically, if you're talking to consultants, they would tell you that there's way too much data and way too many names on this slide, and you got to trim it down and have 2 or 3 things. But this is what investors are looking for now. The investors have gotten far more savvy, and they're digging deeper into these companies, and they're trying to really understand the nuance between what makes a successful Bitcoin treasury company. And if we think that this is going to be a trend that persists, and if you watch the news cycle, it's becoming pretty clear because you're seeing announcements all the time. This is where you come to get your master's degree, right? It's these types of presentations. It's hearing from the people that are doing it at the highest level, who have been thinking about this in a way that people who aren't actually sitting in the seat and executing and talking to the investors and talking to the banks, you're just unaware of what's even out there. So this is a huge move forward in investor relations to be able to do this and to empower your investors to now take this data and interpret it and then apply it broadly across an entire sector that's emerging, right? This is huge. So, yes, I'm sure they're incredibly comfortable doing it because they're the leader, right? They are the one leading from the front. They're setting the framework for how everyone else is going to follow, and everyone's going to tweak and find ways to make the strategy their own and how to optimize it based on their starting point. But this is how you get the message out. This is how you show that this is not some, fly by the seat of your pants approach to trying to generate value for your shareholders. This is incredibly well thought through. You're thinking through every concept from how do we view MNAV, right? Because the market hasn't even settled on how they view MNAV, right? They just know they want it to be higher, but they don't know exactly what's going to make it higher, right? There's all kinds of arguments out there. So they give you the vision of here's how we view it. Based on the tools in our toolbox and the amount of Bitcoin we can create and the fact that we're denominating our performance in Bitcoin terms by focusing on Bitcoin per share and Bitcoin yield, this is what we think justifies X premium. And here's how you can expand it. Here's what we think we need to tweak to expand that metric. And here's how we're doing it. That's incredible transparency. And I think that this is a model that all companies are going to need to deploy at some point. They won't, but they should, because this is how you build an equity that has the liquidity profile that MSTR has, right? You don't get this amount of trading volume, I don't care what equity it is, if people don't feel comfortable trading in and out of it and knowing that there's stability here and that this isn't something that's completely erratic. This is incredibly well thought through. It's incredibly well managed. There's a focus on risk mitigation. They're constantly finding ways to de-risk the model and the business. And because of that, investors can deploy huge amounts of capital into this ecosystem. And now you're seeing the benefit of that. So this is a strategy I always look at. Everyone always wants me to comment on what's happening this week or next week or at options expiration this month. I don't care. That's not what I'm focused on, right? I love this strategy. And I think that if you're looking at long-term value creation for shareholders, right, they've been clear, they're not optimizing for traders. So you have to know that going in. And this is how you show that focus on optimizing for long-term trade or long-term investors. You're going to reward the long-term shareholders, and they're going to continue to benefit in Bitcoin terms. And that's an incredibly powerful shift in narrative.
Yeah, your point about the constant optimization, I think, is the key. Because, people will say that AI is the least powerful it will ever be. And strategy has 3,000% gains over 5 years. Bitcoin is like 1,000. So they've 3x'd Bitcoin in 5 years. And this is the least efficient MSTR will ever be. The future is going to be better than that.
Hell yeah.
So the days of them begging the bond market for good rates and favorable terms, that's all over. The days of, being helpless during a Bitcoin market because they didn't have the preferred tools, that's all over. It's only going to be more efficient.
Wow. Yeah. It's like
Yeah. I'm going to say this to the older people on the call. And I don't want to give financial advice, but if you think that your job is going to be displaced by AI or a person using AI, you pretty much have a simple choice. You could either get good at using AI, and if you don't have interest in doing that, that's probably not good for your career, you better get some Bitcoin in case it catches on, because that's about the only thing that's going to save the white collar 40 to 60-year-old person that's going to get displaced by AI by a 25 to 35-year-old person that has better technical skills. This is exactly what happened back in the olden days with the internet bubble. It's the same thing. They got displaced. They couldn't understand the internet. And now, I don't understand AI. I don't use it, which I think is kind of crazy because ChatGPT has 700 million, whatever, daily or weekly users. So there's a lot of people using it, but you better get good at that. And if you don't, you better have a plan B or a backup plan.
Yeah.
Well, strategy is showing
Okay.
you what happens when you have AI and a vision. And you need both of those things, right? AI tools are as good as what you're willing to put into them. And when you have a clear vision for what you're trying to accomplish, and you've already decided that you're going to throw out the old playbook, right? There's going to be a million, I'm sure that this had to be a very frustrating path getting all these preferred products out into the market for strategy, because I'm sure at every turn, the bankers were telling them, well, this isn't how these work, or investors aren't going to know what to make of these products. So you have to be willing to utilize that technology in a way that pushes boundaries and creates something new. And what they've created here is spectacular, and it's scalable, and it's powered by effectively the capital that opts out of the system that you're watching be manipulated in front of your eyes. And you cannot understate how powerful that is, that you're backing the entire balance sheet of a company by truly decentralized capital.
It's crazy.
Right.
Yeah,
It's a massive shift. And then you're
it's a
building
massive shift.
products on top of it that take advantage of the fact that because they tell you that the US dollar or whatever your fiat currency is, if you're issuing preferreds in another country, like it looks like Japan or Metaplanet's going to do in Japan, and several others I'm sure are going to pop up in their own respective markets. If they're telling you that they're going to be debasing the currencies, and that you're capitalized on an asset that's truly finite, completely fixed supply, and that no matter the demand that comes in, right, no matter how much corporate demand comes in, no matter how much nation state demand comes in, no matter how much retail demand comes in, there's not going to be any more coming into the market. The only thing in that model that ultimately is going to give is the price. And because of that, you can build a long-term thesis around that arbitrage. And that's what you see with these prefs, right? They're clipping the first, 8 to 10% of that Bitcoin CAGR, and they're passing that on to the people that want a fixed payout. And then the remainder of that flows into the common stock equity holders, right? So if Bitcoin continues to perform at a really high level, it's a hugely beneficial ecosystem to be participating in. So it's one of those things that just every time you see a presentation come out like this, you get excited about it, right? I mean, to sit on an earnings call for 2 hours to watch people go through the high level vision and then explain it to you in granular detail how they see it. I mean, there's nothing better if you're passionate about an area than having this type of access to both the minds that are creating it, as well as the output of how they're thinking. It's a hugely powerful combination here.
So I want to hit on a couple more things, and so we could shift gears, just recognizing time. But incredibly important parts of this, they gave Bitcoin guidance. This is the first time they gave Bitcoin guidance, and I think they kind of underestimated Bitcoin price relative to the analyst Bitcoin prices by the end of the year that were earlier in the presentation. So they came with a conservative estimate of 150,000. They bumped up their Bitcoin yield. So they shifted their Bitcoin yield target at the beginning of the year was like 15. They plowed through it. They pushed it to 25. They plowed through 25. They shifted it to 30, and we've got half the year left. And increased their Bitcoin dollar gain target. Awesome to see guidance like this. The other thing is they put out earnings guidance, which is a function of the underlying Bitcoin price. And you start backing into this earnings guidance relative to some of these other large companies, and it is just monstrous. And it's insulated. If there's any change in market sentiment in AI or any blow off top in any of those things, this is likely to be insulated from any froth because it is value. There's true store of value that they're holding on their balance sheet here, which I think is fascinating. The next one, this was huge. Josh Mandel was on fire. He was all about this. We got some MSTR MNAV equity guidance. So it looks like they changed their algorithms for issuing the MSTR equity. So right now, I think MSTR MNAV, which is the multiple on enterprise value, is how they calculate it on strategy.com. It's the enterprise value as a function of the underlying Bitcoin holdings. So right now the MNAV is like 1.7, and below 2.5 MNAV, they will not be using the MSTR common ATM, which has got to make people happy, right? There's Jim Chanos trade doesn't work anymore. And there is going to be no additional equity issued to the market until 2.5x MNAV. And then between 2.5 and 4, they don't even say that they're going to use it all the time. They say they're going to opportunistically issue MSTR to acquire Bitcoin. So, it's probably similar to kind of what they have in place right now, on, good days, positive days, whatever. So I think that's really positive for the underlying equity. And it was good to see some guidance here. And then STRC credit guidance, they refined this a little bit, just showing exactly how they're going to try to keep this in the target range between $101 and $99, which this is just going to be such a fascinating product. And I know a lot of people are fired up about it, because once we get it to 99 or 100, if there's additional volume coming in the door, they're going to do a 5-day VWAP and issue more shares of this stuff out to the market to bring the price back into target range. So as the world wakes up to this instrument and it continues to trade up higher, they have the ability to just continuously raise capital if there's more volume, excess volume coming in the door on these things. So, I had 3 conversations with people today about STRC, and people have talked about MSTR for a really long time. They've got a little bit of MSTR, but they've always been just like a little hesitant about it. And I said, hey, this is a really cool product. You got to check it out. And that's, I'm just one step at a time. And, it takes a couple of people having really improving their life from having this instrument. It takes a handful of those people telling a handful of people, and all of a sudden you're Kevin Bacon, seven layers of separation, and your stretches in every brokerage account of every person in the United States.
I think this one becomes massive because, one, it's just got characteristics people like. They don't like to wait till the end of quarters to get dividends. So if they can get monthly dividends, it feels like it's working for them more. So I think you see a lot more capital coming in, and they're going to be pretty active trying to keep it capped at 101. But also every month when that dividend gets issued and you get all the reinvestments that come, right, the drip, they've got an opportunity right there to effectively try to neutralize that new buying pressure with new shares in the market so they can recollect that capital.
The drip just comes back.
Exactly. So this is one they're going to have to actively hit, because you saw what can happen, when those dividend reinvestments hit. We saw it with all the other prefs, and things spiked in a really crazy way. So on this one in particular, they're going to have to be ready for that. And I think they're going to be putting a ton of shares in at the end of each month when those dividends are getting paid and going back into the reinvestments. So, they've got an ability here to raise a lot of capital, and the larger this thing scales, the larger that opportunity every month comes as well. So I think there's just going to be a huge amount of capital they're going to be able to raise with STRC. This is going to be a really powerful tool. And on the MNAV and the ATM, I think it was big, right? I think the timing was right, because the common stock ATM had really become the primary capital raising tool for them for a very long time, and that's a delevering instrument. So every time they were raising capital via the common stock ATM, they were adding Bitcoin to the balance sheet. It increases the fair market value of the Bitcoin. It delevers the balance sheet. And so it was hitting this point where they were going to become increasingly delevered with time. And now that they're sub, what are they, including debt and prefs, like 11% or something like that? Oh, it was in your sheet. I can't remember.
Oh, yeah. Like
11% leverage. Yeah. And if they're looking at it, and on that one slide, they showed that with just the prefs, because you're managing the annual dividend obligations, 30% is no longer your ceiling, right? You could go higher on the leverage, knowing that they have to scale these products now. even in order to relever, they've got a long runway of raising capital through these preferred products before that leverage ratio really climbs in a big way. I mean, there's a ton of capital they have to raise to get that up back to 30%. I do the math here, but I just shut that part down. But we'll figure out what that number is. But it's a lot of capital to get back up to 30% leverage.
It's huge.
You know, they're going to be aggressive here, and I think that the 5 months of the year, there's going to be way more capital raised than people are anticipating.
Mm-hmm.
Bigly, a lot of capital. Bigly. Last thing is talk about comparables. I felt really seen by Fong here. Big shout out to Fong, because I've been trying to say a lot of this stuff and they just put it together in a presentation and they just took it off my back, which is great. But benchmarking strategy to the top S&P 500 companies. They've got 9th in operating income, but 96th in market cap. They're 13th in estimated income, but 495th in PE multiple. And I know some people put in the chat, Exxon is a balance sheet company. Exxon, balance sheet company, 16.5x PE multiple. Berkshire Hathaway, balance sheet company, 25x PE multiple. And you look at some of these crazy ones here. The one that's not on here is Palantir, which there's been a lot of energy and people talk about that today. But there's a 675x PE ratio.
Is that all?
So, yeah, there's you know how we talk about real estate? There's a lot of monetary premium in real estate. And there's going to be a reevaluation of real estate as monetary premium gets sucked out and all this risk gets reevaluated. I think the same thing exists in 493 of the stocks in the S&P 500. And you can see it here. Who's buying Broadcom? There's no irresponsibly long Broadcom communities out there, right? Like, I don't know. Maybe there are, but I just haven't looked at it. Irresponsibly long Walmart. I don't know. And that's even as a Walton saying that, dissing on my name brand, I guess. But I think there's a lot of opportunity here. And I think the world will eventually wake up to this. And the other interesting part is all of these companies on the right-hand side, Strategy is the only one that's not actually included in the S&P 500. As I've mentioned in the past, the S&P 500 holds like 6% of most of these equities on the screen. So as that continues to change and we see this speculation on what they get included in the S&P 500, it's just going to be a fun conversation. You've got these two valuation systems that are clashing in epic proportions. You've got balance sheet value investing, discounted cash flow, expectation of future cash flow investing, and the valuations of those two are clashing in just monumental proportions.
Do you think one thing that surprised me, when the guidance came out, right? Obviously, this earnings was a massive deal because this was kind of the culmination of everything that had been happening for years now. It was the first time that they could realize that value. And this was $10 billion in net income. And now you've got guidance just for the rest of this year for $24 billion. If they start showing quarter after quarter after quarter, right? If Bitcoin continues to perform and if Saylor's correct that winter's not coming back and the structural bid builds up underneath Bitcoin because all these new corporations are coming in and other people will get in the mix as well. I mean, that type of earnings is pretty incredible. And when you see it, I think right now you're still in that position where a lot of people that haven't been following this for a long time will go, yeah, but it's a one-time event. Right. They got to recognize at this time, marked it to fair value. Okay. One-time event. I think seeing it multiple quarters in a row, particularly if it happens to be in $10 billion type range, is going to continue to bring eyes in and start getting people interested about what is going on over here. What is the model that they're deploying? Why is this, small software company just dominating the fixed income markets? Like, what is happening? Yeah. So I do think that, while this was a huge deal, I think that we're still in the phase where people can shrug it off and go, well, it was one time, it's not going to happen again. And now if it does happen, repeatedly, particularly throughout the year, and if they hit that 24 billion mark that they're guiding towards, that's going to be powerful for messaging for all the Bitcoin treasury companies.
If Bitcoin goes to 200,000, the net income goes to 80 billion.
Yeah.
That's 80 billion additional. So then they're going to be sitting on $150 billion of this stuff of Bitcoin, right? They're right below NVIDIA in this chart. Okay, if Bitcoin goes to 1 million, that's $500 billion net income. That's 5x all of these, right? That's
Those
5
numbers
years.
are too big, Jeff.
That's
We need
5
to
years of
start with the
Google.
smaller numbers here that people can
That's
conceptualize. Those
5
numbers are too
years of net income at Google, like the biggest net income.
How big is that neighborhood with $1
uh,
million homes in it,
That's,
Jeff?
that's a big neighborhood. we could go back to that one. Okay, I'm gonna stop sharing my screen so I can get my screen back, and we'll. Man, that was cool. That was a great earnings call. Once again, a masterclass. They're just trying to communicate to the market, and that's all finance is telling a story. They just got to tell their story and
Yeah, but
communicate effectively.
right. But Jeff, let's be realistic. 400 companies out of the S&P 500 have a crappy story.
They don't have a story.
It's
don't have a story.
that's why they and so the CFO has got to get on the call and talk about, and if they don't have good metrics, who wants to be on that call, right? And take questions. I mean, it's, we've all seen, well, so a year ago from Strategy World, the previous year, I was there with Ryan and Plank, and maybe there was 150 people in the room. And then this year it was outrageous. That main stage that he was on with Saylor. I mean, the TVs were what, 20 feet tall and 100 feet wide. I mean, it was crazy how in 1 year, just everything had changed. And you don't see that. Like, where's the irresponsibly long Broadcom group? Maybe somebody's listening and will be like, there is one and we don't know about it. But I want to just say something here. If people will see that my sentiment has fundamentally changed where it was for the past 6 months and 7 months. And the reason why is one of the main reasons because of this earnings call, because of STRC, because of the guidance, because it was in writing and there are slides in here talking about this. And so once they give that guidance in terms of the 2.5 MNAV on the common stock ATM, and we see this, they listen to feedback. And if a group don't listen to feedback, and the perception tends to be pretty close to reality sometimes. And so if that's the case, then they made a course change. And I commend them for that. If they're listening, if the execs from Strategy are listening, congratulations. You listen to what the shareholders were saying, and we were proud to be part of this group. But we thought that by selling too many shares on the common stock ATM could depress the price specifically of MSTR. And you made a change to that. So thank you. We appreciate that. Launching STRC. I hope it's the iPhone product. I truly do. I think that if they came out with an overnight, Jeff, I think that's a great idea. I like that. I like that idea. If they could do that,
reverse repo, overnight reverse.
yeah,
repo.
It's a daily product, and
brokers would have to figure out how to do a dividend daily and get comfortable
dividend
with that.
daily, because it would be 1 day settlement. I mean, maybe you just do it weekly, but if you could do it daily and it just tabulates it daily, but it pays out weekly, I think that would be if you have the short duration and you have the long duration perpetuals.
You've got the yield curve.
Well, you got a yield curve there.
Yeah.
Look, all my junior enlisted from the Navy, can you get us like a payday loan version?
Yeah.
I'm saying that's what we need.
Give me the dividend up front, and I'll hold it.
I'll pay you back.
I promise.
I'll pay you back next Friday.
Well, however you got back, Rain, we're glad to have you back.
Yeah.
Well, thanks. And guys, look, of course I want to be on these calls and add value to this. But, when I look at it, there's another great slide. If you could pull it up, slide number 26.
Yeah. Give me a sec.
And the reason why, because there was an interview with, what's his name? The guy that's on CNBC, the option guy. I forgot his name right now. It was a quick clip. It was 20 minutes long. I had reposted it about a week ago. And what he said was, the question was to Saylor was, who have you spoken to that would surprise us without releasing any names? What company or country? And Saylor came back and said, I haven't really spoken to any company that would really surprise anybody. But then what he said was the only serious conversations he has is with the United States. So he said that And then you see slide number 26 come out here because this administration has embraced Bitcoin. And there's people that have been left off of this slide also. That what's his name? Bo Hines, for instance, is not on the slide. So there are people that are left off. And we've talked at the Bitcoin conference. I talked to a lot of staffers for Cynthia Loomis and other people there that were bullish. You know, the younger staffers are bullish on Bitcoin. So this is a fundamental shift that he talks about. And then not only do you hear about this when he does an interview, but then you see it in the Q2 report and you put a picture with a face to it. And so he not only did he change the FASB accounting, but because of the change in the political structure of the US, it got rid of Operation Choke Point. And then, by the way, if you scroll up or down, blah, 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 hold on one second. Where's there's a slide with the Clarity Act with the 3 acts in it. Slide 37. There's a slide on the FASB. Capitol has embraced Bitcoin. So the Genius Act was approved and got through. You got the Clarity Act and the Bitcoin Act trying to get those through. So my takeaway is Bitcoin has to perform because you've got what you saw in this section here is being important, that these people came in. There was a change in the political winds in the U.S., and therefore now this is the best tailwinds you get for Bitcoin. Right? I mean, does anybody disagree? I mean,
it's fantastic. I mean, the architecture again has changed, and going into midterms in like almost a year, that's probably pretty important too.
And what I've seen, what's very difficult in any political thing is that once something gets done, it's 10 times harder to undo it. It's very hard to get something accomplished, but once it's accomplished, to undo it is very hard. So in this particular case, an Operation Choke Point did not go through Congress. It was just more like policies were there. So these undid it by law. And I think that this is a fundamental shift. So again, what changed my sentiment? It's changed based upon the information that you see in this deck that may not be, it's directly related to strategy, but it's related to government and guidance and sentiment and so forth.
It's really one of the first times where you look forward into the future and you don't see nearly as many potential roadblocks that can be thrown in your way, right? It feels like from this point, particularly now that investors are getting easy access and exposure to Bitcoin through brokerage accounts, which means you've got a lot more people likely getting that exposure. And obviously the success of the ETFs is proving that out. You know, those are important voting blocks. So for any political party to come out now and decide that they're going to go anti-Bitcoin is going to be a massive, massive risk, right? The move is really to go out and say, we're more pro-Bitcoin than the Republicans, or we're more pro-Bitcoin than the Democrats, right? We're all about empowering you and, allowing you to buy whatever commodities it is you want to buy. It is one of those first times where it feels like we're catching a tailwind instead of pushing through a headwind. And just that shift alone is huge. And investors are waking up to that. And I think they're feeling more confident deploying capital into this space, which means more people are going down the rabbit hole of understanding what Bitcoin actually is, why they should be holding the asset themselves, right? Participating in what makes it powerful. I'd be curious to see the stats on, like home miners that are getting sold, these small solo miners, because I think that would be a really interesting trend to see how many people are starting to try to participate more in everything Bitcoin has to offer, whether it's running a node or running a miner in your basement or whatever it is. I think that the uptake in that type of an education and adoption, as people understand just how powerful it is to have a fully self-sovereign asset like Bitcoin in your portfolio can be. And then, obviously brokerage accounts are a massive top of funnel for generating interest. And as their brokerage accounts perform, it just sends you deeper down the rabbit hole because you want to know what is the asset that's making all of this possible.
Bingo. We're getting close to, we're over an hour and a half. I wanted to try to keep it at 90 minutes. So I've got one final thing to talk about, and it's just this Bitcoin as a unit of account. And maybe we'll make this 2 hours. Who knows? I don't know. But I just shifting gears here a little bit, and something I'm noticing in the marketplace, and just a general trend, and I think it's worth talking about. is a lot of people are doing a ton of analytics on Bitcoin treasury companies right now. Fantastic. It's absolutely great to see. There are little communities that are popping up everywhere. They're following these stocks. This is just great for the entire ecosystem. What I don't like is that it's like infighting between all of these people. You need to buy this because this metric is slightly better, and this Bitcoin treasury company is going to outperform this Bitcoin treasury company. It's like, whatever anybody does with their investments is fine. I mean, this is all good for the general Bitcoin ecosystem. And where I think the bigger fight and the bigger argument is here is against the traditional financial markets. And all of these analytics can be done. Just take the same framework and apply it to all of the traditional financial ecosystem and start seeing the world in Bitcoin, and your whole perspective on the rest of the world completely fundamentally changes. And this is a call to action to people to start to use the same Bitcoin framework and think about the rest of the equity market and the rest of the fixed income market. And like, this is a campaign here. Like, if we really want Bitcoin to become adopted, there needs to be stepping stones to get there. And it's through communication, it's through analysis, it's through doing things a little bit differently. It's not through infighting about which treasury company has the best months to cover MNAV. I mean, it's great information and it's like great analytics, but it's like not useful time and energy spent. And I just this is just an example, and there's so much opportunity in this space to like rethink the world in Bitcoin of all these other things. And this is just an example that I've just was starting to come up with, and I posted this on my Twitter feed. Is so on the left-hand side, this is CrowdStrike. CrowdStrike was recently added to the S&P 500 because they had 4 positive quarters in a row. And I went back and I wanted to see, okay, their net income. I wanted to price their net income in Bitcoin at the time they announced earnings. So I took the price of Bitcoin at the time they announced earnings and I converted it into Bitcoin, and I just looked at it over time. And I wanted to see like how much Bitcoin would they have stacked if they would have just bought Bitcoin with 100% of their net income, and like what would their position be? And you look at this company, CrowdStrike, and effectively they've lost like 18,000 Bitcoin over this horizon in net income perspective, which is like a negative $12 billion loss relative to the negative $2 billion loss they actually posted in dollars. But if you think the world in Bitcoin, that's a significantly bigger loss. Your opportunity cost of capital is really high. And it's an interesting perspective. And then you start to look at this one over on the right-hand side. This is Nike. And this is net income over time. And you look at during 2020, obviously, they would have purchased a lot of Bitcoin, and same with 2022 in the bear market, which is kind of in the middle here. But on the right-hand side, you look at their ability to raise this capital, this permanent capital, and hold into the future is dwindling. And that's just making the moat of any of these Bitcoin treasury companies greater and greater. You look at a company like Strategy that holds 600,000 Bitcoin, and like even if you combine all of Nike's past, 21 quarters here, it's still not more than 600,000 Bitcoin. It's maybe close, but that's 21 quarters of converting 100% of their net income into Bitcoin, which they're clearly not going to do. But it's just starting to see the world through a little bit of a different lens. It could be really helpful in communicating to other people.
I also think that because we're moving into the age of rapid disruption, right? With AI coming, there's going to be a huge amount of disruption to a lot of different industries. And one of the things that I've been starting to focus on is looking at more of these traditional equities and looking at how resilient are they to that disruption from a financial strength perspective. If they come in, you've seen it with some of the announcements that have come out, like what was that AI tool that came out of China that, said they basically launched it? Yeah, DeepSeek. And like when that came out, it just totally shocked everybody, right? Like, oh my gosh, is this industry already getting disrupted? This is supposed to be the one that does the disrupting. That's going to come for a lot of these other a lot of these other companies, because now you've got these smaller nimbler companies that are enabled and don't have all of the built up overhead of decades of operating and building out org structures and hiring people. And, and they're going to be able to build more efficient operating models and better product sets. And you start to look at what optionality do those companies have if disruption comes for them, right? So if you've got this massive war chest on your balance sheet and you've built up a really resilient balance sheet, you've got the ability to reinvent yourself at some point in the future if you need to. It's optionality to buy yourself time. In a lot of these companies, because they have to constantly be reinvesting all of the capital that they bring in the door, because it's all about expanding the next quarter's earnings. And so they've got to pump it into sales and marketing and R&D, and they've got to just keep putting all that capital out the door, and they never get to accumulate any. They never get to build a war chest. If they fall behind in that race and they get disrupted, their timeline is short. Whereas if you're a company that holds, more than 600,000 Bitcoin worth, 70 some $1 billion, and you've got a relatively low burn, which is what you're looking at with this, annual dividend payout. If you start looking at other companies through that lens and going, how resilient are they really? If they get disrupted, how much runway do they have to pivot if they need to? And the answer in most of these instances is going to be not very long.
Netflix.
Huge overhead. They've got huge risk associated with those business models. And I think that that's part of the value proposition of starting to talk to these companies about the opportunity to stand up a second value creation vertical within your business, which is completely focused on deploying the balance sheet and building that war chest while you're still operating your business. Go ahead, keep operating that business, keep building it, keep making it successful. But on the other side, when you've seen what Strategy's done, where they've deployed this strategy through their treasury and built this massive war chest and generated additional value for their shareholders that wouldn't have been created through their standard operations, that's a powerful shift. So I think kind of shifting the way you view these companies, both from the way you were saying, Jeff, looking at, net income or converting EBITDA over to Bitcoin terms and seeing whether it's, eroding out from under them or not. And then looking at the composition of the balance sheet and figuring out just how resilient this company is and what optionality they have for the future is going to completely change the way that you view companies that you've typically looked at as bulletproof.
Yeah, so
Go ahead.
that's wild,
Yeah,
Ben, because you're so the AI, you can leapfrog someone, right? You can disrupt them. Whatever industry you're in, you can be disrupted. But the only thing that can't be disrupted is a Bitcoin balance sheet because it has a fixed supply.
Bingo.
So these companies that are still on zero Bitcoin, they haven't gotten off zero. They don't even have a runway. The only companies that have runways at all are the Bitcoin treasury companies. And everyone else is just falling farther behind because they're not even in the race.
Yeah. And a lot of these companies, I mean, their financial performance is reliant on, you're seeing things that pop up like tariffs that then have to get passed through to the end consumers. And so their cost of goods goes up. So they get to raise the prices on their products and they're passing that cost down to the consumers. So it looks like their revenues continually increasing, quarter over quarter, and their bottom line increases proportionally. But really, they're just, passing through, and the debasement of the dollar is what's fueling all of that continued growth and all these earnings. So, I mean, it is one of the things that if you're an executive, you have to focus on that, right? Because if we've learned anything in the last decade, it's that no business model is safe, right? Go back 30 years and look at the companies that were dominating the market and see how many of those were resilient over time. Not many. Right. They all disappeared and they didn't have the opportunity to reinvent themselves. They eroded down, the value eroded out, and then they went out of business. You have
Green, tell us about Kodak. Tell us a story about Kodak, please.
I have a story about Kodak. So wait, this is crazy. So back in the olden days, during the internet bubble, I was working for Global Crossing, and I'm like, cool. They're going to send me out to Global Center because Global Center housed Yahoo, and they're going to send me out to Santa Clara. And then after I get the job, they're like, dude, you're going to Rochester, New York. And that town was built obviously on Kodak. And I lived in walking distance from the George Eastman's mansion. And I lived in a little small house. But anyway, so I was there. But while I was there, the next door neighbor was the mayor. and the mayor did not know that Global Crossing even existed. Because I was talking to his wife and they said, "Oh, what are you doing here?" I go, "I work for Global Crossing." They bought Frontier, the phone company. And they're like, "What's Global Crossing?" So this was one of the internet darlings. The mayor of the city did not know that one of the biggest companies during the internet bubble had bought Frontier Networks to get a phone company, and they were completely, but they did not understand anything that I was talking about. They had no idea. So you probably don't even knew the story that I just told you,
No.
but oblivious to this completely. And then eventually I made it out to Silicon Valley after being there a year and a half, but they had no idea what was going on. This is all before the iPhone and all of that. So I mean, I want to get back to unit of account we're talking about. And I read these comments. Look, there are different market structures in different countries, whether it's Japan, whether it's Europe. And by the way, the UK is different than the European Union because they have a different currency, and they exited whatever 2-3 years ago. Somebody will correct me. So the point there is that these Bitcoin treasury companies can have a home field advantage in a different currency with a different market dynamic. And if a spot Bitcoin ETF is not available in that country, then the Bitcoin treasury company may be the only way that you could acquire shares in a Bitcoin treasury company is to acquire those shares in that, because you can't easily buy Bitcoin. So from that perspective, I want to see other Bitcoin treasury companies to be successful. And then in their currencies, that'll be great. Then somebody can say, "Oh my God, well, what happens if a spot Bitcoin ETF comes out?" Well, we've already done that in the US. That happened January 11th of 2024. Get that right? Yeah, 25.
Yeah.
Right, 2024. And what happened is strategy stock still continues to go up and to beat that MNAV, the multiple of the Bitcoin that it holds. So what am I seeing for unit of account? I want other companies to be able to replicate this, to be successful, because they're buying Bitcoin. And that reflects the flywheel. If they could then do that, I already posted about this 2 days ago. If they could come out with a stretch product, an STRC, that does the same thing in their own country, again, that buys Bitcoin, that drives the price of Bitcoin up. I don't know why people would be against this. So I don't like seeing the infighting. I think that, there might not be enough Bitcoin to go around and the price goes up. There's nothing we could do about that. Okay. So my takeaway is
it's great for the ecosystem.
Yeah, it's great for the ecosystem. It brings in other countries, other people that are excited about this. You see the picture, what happened with Metaplanet, the earnings call, the picture, the one they had a year and a half ago, and there's like 6 people in the audience and 4 of them work for the company. And then you see the next picture and there's 300 people in the room, standing room only. And I think that getting that narrative that and the attention-driven society, that this is something important, it's new, and it could save your retirement. And if you don't understand AI, you better have a freaking backup plan.
Yeah. Another interesting thought I had just earlier today, I think I saw that like Amazon was making AI available for anybody they've got on Amazon Prime, and maybe it was ChatGPT. But I was just made this realization like, oh my God, AI is going to disrupt AI. And so you're going to have all of these AI companies that are going to get just these like super frothy valuations because it's like AI. It feels similar to maybe .com, but maybe different because there's significant efficiency in a lot of these things. But some of them are going to gobble up everything else and be able to disrupt that industry as well. We just have no idea what this looks like and how we come out the meat grinder on the other end. It just never ends. I don't know.
The weird part about AI is that the people that learned how to code, AI can probably code better than you. So as long as you could do the prompts, and I know people that can code, and a year and a half ago, they're saying, the code that came out of it wasn't particularly good. And now it's like, well, the code comes out 97% great, and then they just have to go in and debug the last 3%. And so what I'm seeing, I'm here in Silicon Valley, so we're seeing this. So it increased the efficiency of the coders and be like, oh, this is great. I'm like, you're not particularly smart, are you? Because
This is
now
how we
they-
get to idiocracy.
they need less coders then. If one guy's now, if you only had one super coder, now you have one super coder, you have 4 AI coders, and fire the rest of the people.
The problem is it's disrupting everything people didn't think it would, right? I
Mhm.
mean, everyone thought this was that technology would show up, it would take over all the blue collar jobs, you wouldn't have anybody working in a McDonald's anywhere in the country, all that. But, where it's starting is it's all of the professional services, high fee, so even things like attorneys are getting disrupted by AI in a big way. Coders, I mean, software developers, just 3 years ago, that was what everyone was telling you needed to do to be resistant to disruption, right? Go learn how to code, right? There was the big push for it. That was supposed to be the thing that would keep you employable for a long time. And now, yeah, I mean, the AIs now are very good from a coding perspective. I use them almost daily.
By the way,
Uh,
I want to say this. Um, Dan's not on the call. Dan Hillary's not on the call tonight, and he did this great video. And in the backdrop of the video, he was showing like this, and he was showing his desktop. So he had this great Excel spreadsheet. I don't know, it was 6 columns, and there was at least whatever 75 rows in it. I screenshotted it with his picture in it, screenshot it, uploaded to ChatGPT, and I had it analyze all the numbers that he had, and it was able to back out and figure out all of the formulas that he put in for each column. And now I'm going back and forth with the two Dans. They're like, "You did what?" I'm like, "Dudes, I just screenshot that, put in the ChatGPT, and then I query it for the next 20 minutes, and then I call you up and see what you guys think." And I'm telling people, and by the way, Saylor said he does this. It's not like I figured this
Yeah.
out on my own. Saylor said at Strategy World, he said, I figure out I want to do a new product. I go into deep research mode. I go into it. I figure this out how I want to do it. And then I copy and paste it into an email. I send it to the lawyers. And here's all the citations for everything that has to be done for all the financial information. Go get to work. And he already did 6 months worth of research for them. And he gives it to them. Now, can you imagine that if you're the lawyer on the other side? You're like, oh, crap. This guy gave us all of his info already. Now we
there
got
goes $1 million in billings. Yeah.
right. And now, and then he's like, because that as soon as they give the information back, he copies it, pastes it into AI, and then writes it back to them. I was like, once you see how fast the permutations iterations, how fast things leapfrog. And so he said this, and I think that's what people have to understand where this is going.
Yeah. You got to use it. You got to use it.
Strategy's using AI to create the preferreds, and then I got to use AI to tell me what it means when they come out with a new one.
Right. And by the way, some guy today on X is like, this chart doesn't show me, doesn't accommodate, it showed the amount of debt being acquired per person over time. It doesn't show the rise in wages. I copied and pasted the chart into it. And I told ChatGPT, I just said, and this is not an advertisement for, you could probably do it in Grok or the other ones. And I just said, could you reanalyze this chart, recreate the chart and accommodate it for the rise in wage, do it on 3 different y-axes, keep one x-axis for time. This took me like 3 minutes. I just wanted to see how hard it would do it. And I posted it up. Nobody clicked the like button. But when somebody says something to me and they're like, what does this mean? Or why did you do, or I think it should be like this. Well, why don't you use ChatGPT or use AI, make your own chart and post up and say, I think you're wrong. And here's the chart. And I was smart enough to use AI to do it. If somebody can't take that effort to say, I disagree with this chart, but then they're too lazy to use AI to refute the chart, that is mediocre thinking. It's just,
Here's what I'm going to say. It's going to get increasingly important to get away from the screens and go outside and touch grass, because every algorithm out there is going to be optimized to keep your attention.
Mhm.
Yes.
Oh,
It's gonna get
yeah.
really
yeah.
hard to pull yourself away, and you got to train yourself early to shut it off.
Ugh.
Go outside. There's a lot of really cool stuff out there. I know a lot of us probably haven't seen it very much recently, but shut down the screens, go outside. The AI is always going to be there. It's always going to be looking for you. I promise.
Yeah. So I'm going to sign off, guys. Look, this was a great call, but one of the reasons why I've been missing in action is because I've been enjoying the summer. And I think that sometimes I like to be inspiration that if you've been on a Bitcoin unit of account for me, like 8 years, then I wanted to take off and enjoy the summer. And I got plenty of plans, but I'll be in New York. Shout out to Tim Kotzman, the Unconference, September 17th, Wednesday, September 17th. The band, MSTR. Well, where are we just True North now, not MSTR True North?
True North.
True North. The True North folks, we're all the group's all going to be in New York City Wednesday, September 17th. We're going to be there. We're going to have different events on other nights. Some will be informal. We'll just show up at Pub Key. We'll announce this. So shout out to Tim. I would recommend everybody getting there. Sailor will be a co-host. You'll be able to meet these people, talk to them in person. If you've never been to an event, get there. Okay.
Yeah,
So-
go see. Yeah, meet people in person. It's gonna be a good time. It's gonna be a great time.
It'll be great.
Yeah, and on that last point, I guess we'll hit final thoughts. We'll wrap it around, but yeah, it's summer, and go enjoy summer. And we may not do this every week. And when we first started this, or like, well, let's just chat, and when it works, and it works, and when we're traveling, we're not going to do this. And if we need to take weeks off, we're going to take weeks off. So don't go roasting us and trying to say like it's True North dead and falling apart. That's crazy. It's like, what? Like, we have lives, guys. Come on. Like, there's things going on.
We'll be here every week in the winter, guys.
You know,
Comes out right.
there's
Yeah,
some
right.
winter when I got nothing else to do. Yeah, we'll be here. But it's sunny outside, so go take advantage.
Yes. Enjoy the summer.
Cool. Final thoughts, Ben, Soleil?
I'm good.
Yeah. Short and sweet for me. STRC, make dry powder great again. Put it on an orange ball cap. Put it in the merch store.
Make dry powder great again. I don't have anything else to add. We'll end on that. All right.
That's the best way to end right there.
Yeah.
That was perfect.
Great. All right. Thanks, everyone. Appreciate the time. And we had 26,480 people. Thank you, Sailor, for the retweet. That always cranks up the numbers. Hour and 57. And episode 35 is finished.